Let's discuss global markets with Mark Matthews, head of research Asia with Bank of Julius Baer. Mark, what a delight to have you back on ET Now. Thank you for joining us. Mark, globally, do you think it's time to be optimistic now? Because whatever could go wrong has gone wrong. Italian bond yields have shot up. There's a run on Spanish banks. France and Germany are not talking. China, there is a visible slowdown. And U.S. economic data has been mixed.
Nikun, I'm glad you asked that question, because I think it's easy to panic in times like these, and usually we look back and realize that panicking wasn't the right thing to do. Having said that, there are differences between this and what happened last year, and I think the notable ones, in my opinion, are that whereas last year really what caused the big bounce in the markets was the LTRO from the European Central Bank, their quantitative easing in December and February. This time the president of the ECB has basically said the onus is on the governments in Europe to get their acts together, and he's not going to do that again. And then, whereas last year the U.S. looked very weak and a lot of people were talking about a double dip, this year the U.S. looks fine, but China has slowed down faster than people had anticipated, and so is India, actually. So I think the emerging markets are under scrutiny this year. Anyway, a long-winded answer to your question. I think there's certainly a lot of policy risk, and whereas I personally don't think Greece will leave the euro in a disorderly fashion, there's still a lot of policy risk in the air.
But Mark, what is your sense? Do you think the Greek election outcome on June 17th is going to be extremely critical and dictate which way the European markets and the world markets in turn are headed in the near term?
Could be, because if the left-wing coalition do manage to get into power, they have said they do not intend to abide by the terms of the existing package, and there could be a disorderly departure of Greece following that. And my sense is that even if there's a very strong response to that kind of departure from the governments and the central bank in Europe, it would still cause another pretty big leg down in markets before we bounce. So yeah, I think it's important.
Mark, as of now, recession is official for Europe. Do you think it's a matter of months and it will be depression which will be official for you?
It's certainly looking like the bounce people had hoped for in the second half is not going to happen, just looking at the PMIs that came out last week, and particularly the soft reading in Germany, as well as the German IFO Business Confidence Index, which took a sharp turn down. Yeah, I think it's safe to say that the European economies are going to be much weaker than the street is currently forecasting.
Mark, first it was US Fed, then it was ECB. Now it's the Chinese central bank which has indicated that they are aware of the economic growth. Economic growth is slipping and they will print more money in order to get growth back. So what kind of potential scenario are we staring at? If three central bankers are printing more money, which means more asset price inflation, more money to crude and more money to emerging markets.
So, no, I don't think that's correct, because the ECB has said quite emphatically they're not going to print any more money, and I don't think there'll be QE3 from the Fed. And unless I've missed an important news headline, I don't think that the PBOC has any intentions of doing quantitative easing either. They have cut the reserve requirement ratio, which is the amount commercial banks have to keep as a percentage of their deposits with the central bank, by 150 basis points, but at 20%, it's still a fifth of all their deposits that have to be kept with the central bank, which is, of course, a very high number. So I don't see that picture you're painting. And if anything, I think that what's been overstated is the response of the Chinese authorities to their slowdown. I don't think they will do anything major because I think they're actually secretly delighted their economy is no longer growing so fast. It's politically important for them to try to push down asset prices and inflation because there's been such a big rift between the rich and the poor there. It's developed over the last 10 years.
Mark, so where does India lie amongst a global scenario which is looking so wobbly and news heavy, and also with our own domestic problems, because we've got a slide in currency, we've got a ballooning deficit, and of course a whole host of downgrades as well coming in for a GDP as well as equities. How much more pain for the equities from the current juncture?
Well, it's actually in this kind of environment that India would usually be doing really well because it's the largest uncorrelated economy in Asia to the rest of the world. Exports are not very meaningful, and it's driven by its own domestic consumption. But unfortunately, as you also point out, the story is not very robust on the ground. I think many reasons for that, but the largest, in my opinion, is this policy paralysis, as the term has become defined, which has existed for the last 2.5 years, and I don't see that changing. So ordinarily, these falling commodities prices, oil, gold, and coal, I think, are roughly a third of the current of imports in dollar terms. Ordinarily, the fall in these prices would be good, but as you also point out, the rupee has fallen even by more. It's not going to be the kind of market that people run to for safety.
Mark, so what to your mind is the real value, or I would say the true value for the dollar index?
The dollar index, the JP Morgan dollar, sorry, which dollar index are you referring to?
Well, the dollar index which we used in India for benchmarking purposes, which currently is at 82.
Okay, I'm sorry, I don't have a forecast for that. But as far as the rupee goes, I'd say 52 is probably around fair value, so it's slightly undervalued now.
But are you a bit surprised that even though the U.S. economy is not doing all that well, global money managers, they are still pulling money out of emerging markets, they are pulling money out of commodities, and they are revisiting dollar-denominated assets, especially U.S. treasuries, which offer what, nothing? A yield of 1.7%?
Well, where I disagree with you is on your observation the U.S. is not doing well. I think it is doing well, and I think that will creep up on us continually. I think the theme over the last 10 years was BRIC, and it was a good theme 5 years ago, 10 years ago, but for a variety of reasons, I don't think it's a good theme right now, and I think this slow and steady recovery in the United States will continue to unfold, and the United States will continue to outperform. So I think half the reason why the dollar is strong is because the euro is weak, but probably another half of the reason why the dollar is strong is that the U.S. economy continues to slowly recover.
So for next 5 years, you are a bull on U.S. equities, you're not a bull on BRICS and especially Indian equities. Can I safely interpret that?
I can't forecast that far in the future, but broadly speaking, yes. I think that markets are cyclical, and that's because economies are cyclical. And the U.S. has been in a down cycle for the last 10 years, and it's now gradually starting to turn up. And the emerging markets have been in a big upcycle for the last 10 years, and they're gradually starting to turn down.
Mark, so what is your own estimate of how much GDP growth India is going to see for FY13? Because most brokerages have lowered their GDP target.
I think somewhere between 6 and 6.25, maybe 6.5, would be what you'll get this year. And so, you know, it's slowing down, as is China, as is Russia, as is Brazil. And of course, that's still a very high number compared to what the U.S. will get, or Europe. But I think it's the direction in these things that's important, not the static number itself. And as I say, the direction in the U.S. I perceive to be, on the whole, positive, whereas in the emerging markets, it's on the whole negative.
Mark, what do you make of the investment climate in India? If I look at the investment ratio in India has fallen at an alarming rate, and savings is coming down. So two basic verticals, investment is down and saving also seems to be losing up.
I actually don't follow it as closely as I should, but it's intuitive that there'd be less investment in an environment like this because, primarily because of the government's policies. One would just be much more reluctant to make a sizable investment in the country, given that there's been a lot of backing and forthing on policy, and there's still a lot of overhang on what they might potentially do.
Mark, final question. If I have to ask Mark Matthew for his top investment idea for next 3 years, where would you advise our viewers and where are you advising your clients to put money to work?
Well, the one thing I feel very, very comfortable in telling people to own, although it's not a financial investment per se, is real estate in the United States. I think it's deeply undervalued, certainly on a historical basis, but also on a relative basis. And I think it's now gradually starting to appreciate in value. So that is, and on top of that, I think the U.S. dollar is gradually going to appreciate too. So I think real estate in the United States is a very attractive investment.